Most people have no idea of where they stand financially until it's too late. If you're in your 30s, 40s, or 50s, I'm going to show you the benchmarks you need to hit that we close the financial gap because, well, numbers don't lie. This video will show you where you stand financially and what you can do to accelerate your wealth faster. Let's start by taking a look at the net worth of individuals in America by age. Now, just so we're on the same page, your net worth is what you own minus what you owe. So take everything you own, your stocks, your real estate, your cash, your other investments, and subtract anything you owe, your debts and your liabilities. That is your net worth. Starting with the average net worth, these numbers are according to Fidelity. Under 35, the average net worth is $183,000. For people between 35 to 44, the average net worth is $549,000. For 45 to 54 years old, average is $975,000. For 55 to 64 years old, average net worth is $1.57 million. For 65 to 74 years old, the average net worth is $1.79 million. And for over the age of 75, the average net worth drops to $1.62 million because these people are now pulling money out of their retirement to actually spend it. The problem with looking at the average net worth number is it's going to be skewed because you have some people with extremely high net worths at a very young age, the young billionaires, the young multimillionaires. So these numbers can be skewed. So to get a better depiction of where you stand financially, let's also take a look at the median net worth. Again, these median net worth numbers by household are from Fidelity, and under the age of 35, the median net worth is $39,000. For 35 to 44, it's $135,000. For 45 to 54, it's $247,000. For 55 to 64, it's $364,000. For 65 to 74, it's $409,000. And over the age of 75, it is $335,000. So if you are over this number, depending on your age bracket, you are then above the median in your age group. That being said, let's get into the reality. I don't care if you are below this number, above this number, or at this number. You do not want to compare yourself here because America is facing a retirement crisis where the median American cannot afford a good quality of life and retirement at the same time. So you do not want to compare yourself to the median, even if you're at the median, below the median, above the median. Now I want you to understand, what do you need to do to be able to live a life financially free, and how do you get to those numbers? And it starts by understanding, what is your goal? The first question I want you to ask yourself is, how much money do you need today to be able to live your life financially free? Is it $50,000 a year, $100,000 a year, $500,000 a year? How much money is that? Let's assume, to make it a round number, that you need $100,000 a year right now to live financially free. The next question is, what do you need to do to be able to generate this $100,000 a year passively from your investments without you having to go to work? That way now you're actually free, because then you can decide if you want to go to work or not, because you can spend the next 12 months traveling the world and continue to live your life financially free because you have the $100,000 coming in. So how do you do that? Well, traditional financial advisors will tell you to follow what's called the 4% rule, which means you're going to take this $100,000 divided by 4%. I like to look at something called the 7% cash flow number. I'll explain exactly what that means. Well, let's start with the 4% rule. If you take $100,000 divided by 4%, that means you're going to need $2.5 million to be able to live off $100,000 a year. And what that means now is, if you have $2.5 million sitting in your investment account, you will then be able to pull out 4% of this number, which is $100,000 a year, and continue to live your life by pulling $100,000 out. And now you can live your life hopefully financially free because you have this $100,000 coming in. The problem that I have with this figure is a couple things. Number one is, you have to keep thinking about inflation. And every financial advisor will tell you that this 4% number already factors in inflation, but I don't think it factors in real inflation. Because although the inflation numbers say 3%, the real inflation that many people feel is actually a lot higher than the 3%. So that's my first concern. And the second concern, which is actually the bigger concern, is I don't like selling off my investments to be able to live my life. I want to keep owning my assets while my assets keep paying me. And this brings me to the 7% cash flow number. I know as an investor that I can invest my money into places and get a 7% cash on cash return. Where? like real estate. You can also see it in the stock market, but I try to do this especially with real estate. When I go out and invest in rental properties, I'm looking for a 7% cash on cash return, which means for every $1 that I invest, I get 7 cents of cash flow, 7 cents of profit hitting my bank account every year after expenses. And now if you take this $100,000 divided by 7%, that means I need a little bit under $1.5 million to be able to generate this $100,000 a year in cash flow after expenses hitting my bank account. Now the nice thing about this, and the reason why I prefer this for me personally, and again, personal finance is personal, I don't recommend what I do to anybody else because I'm just a random guy on YouTube, I'm not a financial advisor, is because now when I have this, I can go and do whatever I want, and this $100,000 is going to continue being deposited into my bank account every single year. Now you might say, well, Jaspreet, what about inflation? Well, when inflation happens, what happens to rent prices? Rent prices go up, along with property taxes, along with insurance prices, along with the cost of maintenance and everything else. But your rent prices are also going up. So this number that you're generating will also be adjusted for inflation, because as inflation happens, rental prices go up, your income also goes up as well. And the other thing is, now I don't have to sell my investments to get paid. This is cash flow, profits, dividends from my investments. And now I keep getting paid without having to sell off my investments. So I can continue doing what I want to do and accumulate more cash flow as well. The reason why I'm saying this now is you got to have a starting point, you got to have a goal. Because if you know that this is your goal, well, once you can hit this goal, you're financially free. You don't have to wait until you're 65 or 69 or 73. You can do it at 34. If you know what you're doing and you can strive for this. So let's talk about how you can actually make it happen. So now you understand where you stand financially. But you don't want to compare yourself to the median, because we know that the median American is struggling financially and they're going to struggle to have any sort of financial freedom. That's where we then created a financial goal for you. How much money do you need to live your life financially free? And then you divided it by 4% and 7% to get a range of how much money you'll actually need to be financially free. Now the third thing that I want to talk about is how you actually get there faster with the right systems, and I'm going to break this down step by step into 10 pieces that we know exactly what to do depending on where you are in life, that we can get to that wealth number faster. Step number 1, this is going to seem extremely basic, but you have to start with this: save $2,000. The average American today does not have $1,000 saved up to protect them against an emergency, and the reality is, well, emergencies happen. So I want you to start by saving $2,000 and putting this extra money aside in a bank account to protect you against an emergency. This is not all the money you're going to save. This is the first starting point. You shouldn't be thinking about investing or doing anything else until you have at least $2,000 saved, and during this time, you need to be extremely diligent to not spend money and to work hard to get some extra money that we have this $2,000, because if you don't have $2,000, you are in what I call the financial danger zone. So you should not be eating at restaurants, you should not be going on vacations, and you should not have a Netflix subscription during this time, because you got to get serious about getting your money right. Step number 2 is pay off your credit card debt. So now you have this $2,000 put aside to protect you against an emergency. The next thing you want to do is you want to make sure you never end up in the same financial situation that you were in before. And the way you do that is by paying off your credit card debt. And yes, you're going to do this before you even think about investing. The reason why is because your credit card is charging you 15, 18, 25% a year in interest on your credit card. The average stock market return over the last 50 years has been about 10% a year. So if you're paying 15 to 25% a year on your credit card and you're trying to get 10% a year in the stock market, you have a better rate of return by paying off the credit card debt 1 year early, and it is a guaranteed return because, well, the stock market can go up, but it can also go down. It can also stay the same. If you pay off your credit card debt 1 year early, you have a guaranteed 15, 20, 25% return because, well, that's 1 year that you do not have to pay the interest on your credit card. So when you have these two things, you have credit card debt or you don't have $2,000 saved up, this is the financial danger zone, steps 1 and 2. This is the extreme sacrifice stages. This is going to seem basic for some of you, but this is the extreme sacrifice stages. Right now, no Netflix, no vacations, no restaurants until you get past these two things. And I get it, it's not fun, but the faster you can get away from this, the faster you can start building wealth. And the reality is when you get stuck here, you're constantly working hard to make somebody else rich. The reason why all these banks have these huge high towers and these private jets is because you're paying them that 18, 20, 25% interest on their investments. Stop doing that. Get that credit card debt paid off. That way you never have to do it again. Step number 3 is you need to create a system for your money. Now that you have laid this base, now that you have a financial foundation, you have no more credit card debt, you have some extra savings put aside, now you need a system that way you know how much money you can spend, how much money you can save, how much money you need to invest every time you get paid. And a simple rule of thumb that I like to teach is 75, 15, 10, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum you invest. 10 cents is the minimum you save. This way, whether you make $10,000, $100,000, or $10 million, you're always saving and investing your money before you spend your money. This way, you're putting money aside to make yourself wealthy before you make everybody else rich. And when I say this, the first time people hear it, it's gonna feel a little weird because Jaspreet, I'm already struggling to pay my bills as it is. How do you expect me to live off of 3/4 of every dollar that I earn? And the way that I want you to think about this is if the government was to raise your taxes tomorrow by 25%, what would you do? You'd probably complain and cry and kick and scream and be upset and angry, and then you're gonna find a way to pay it. Because if you don't, you're gonna end up in jail. Think of it like a tax. But this time, your tax isn't going to make the government richer. Your tax is to make yourself richer. If you spend every dollar that you earn, you are never gonna build wealth for yourself because the way that you become wealthy is by investing your money, period. And you can only invest your money if you put money aside to invest, which means you have to earn money and not spend it and then invest it. But if you're constantly making money and spending all of it, you're making everybody else rich. You're making BMW rich, you're making Gucci rich, you're making your landlord rich, you're making your mortgage company rich, but you're not making yourself rich. So if you want to make yourself rich, you have to not spend all of your money. It is difficult in the beginning, but once you do it, you'll start to see, oh, yeah, it takes some lifestyle adjustments, and then you realize you are never going to spend all the money you earn again, and once you get into that mindset, it becomes a habit. 75, 15, 10 is a place for you to start. Create 3 different bank accounts. 1 bank account to hold your savings money, 1 bank account to hold your investment money, 1 bank account to hold your spending money. You need the 3 different bank accounts. That way you have walls between your money, that way you do not accidentally spend your investment money or your savings money. But this is how you now start to amplify your wealth, and this is where things start to get fun. So let's talk about number 4. Step number 4 is start investing your money. Remember, this savings money is just gonna sit there, it's not gonna do anything. This spending money is where you're gonna buy your house, your car, your groceries, your vacations, and all that other stuff. But what about this money right here that's sitting there waiting to be invested? And this is where there's a couple different investing strategies that I wanna go over that let's talk about. The first question that I want you to think about is, are you an active investor or are you a passive investor? And an active investor, I'm not talking about trading. An active investor is somebody who wants to manage their investments themselves. So in the stock market, this is when you're going out and investing in individual companies. You're researching Tesla, you're researching Amazon, you're researching McDonald's, and you want to see, are their financials making sense? Is this an undervalued company, an overvalued company? In the real estate game, this is where you're actually going out and you're finding rental properties, single family houses, apartments, office buildings, commercial buildings, and you're going out and buying them yourself. You're not actually managing it. You're still going to hand the keys over to a property manager, but you're going out and you're finding those individual deals. Passive investing is when somebody else is going to manage the investment for you. So in the stock market, instead of you investing in Amazon or Tesla or McDonald's, you're going to invest into a fund. Something like, say, the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Now, instead of you going out and investing in an individual company, you're just going to invest into a fund that's going to give you exposure to the United States stock market, or the largest 500 companies, or healthcare stocks, or real estate stocks, or AI stocks. So you're just passively investing your money into a basket of stocks because now this fund is managed by somebody else, it's managed by a fund manager. Or in real estate, instead of you going out and finding a rental property yourself, you're going to invest into somebody else's fund. This could be a syndicate deal. This could be a crowdfunded deal where now you're going to invest in somebody else's deal and then they're going to do the work. They're going to manage the property. You're going to get your share of dividends. This passive investing comes with less risk. It comes with less work, but also generally less potential reward. The key here is potential, because sometimes you can make an active investment, which is more risk, for more potential reward, but you can also be wrong, so you can lose that money as well. So less risk, less potential reward, more risk, more potential reward, more time as well. And you don't have to pick one or the other. What I do is I have a mix of both. I have active investments and I have passive investments. I invest into real estate actively. I do have some passive real estate investments, but the bulk, like 90% of my real estate portfolio is active investments. With my stock market portfolio, I have about half in my active investments and about half in my passive investments. So you can kind of find a balance for you, but you have to know what type of investor you want to be. Before I get into the second question that I want you to ask yourself, I want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll even lay out the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It is a completely free masterclass. There's a ton of value in this masterclass. So if you want to watch the investing masterclass for free, all you have to do is register. I have the link for you down in the description below. And when you register, you're also, as a bonus, going to get access to Market Briefs, which is my newsletter for investors, completely free. The second question I want you to ask here is, do you want to invest for growth or do you want to invest for cash flow? Investing for growth is you invest your money into a stock, $100 today, hoping that it's going to be worth $200 in the future. Or do you want to invest for cash flow, which is I'm going to invest this $100 today and then I'm going to make a few dollars back in cash flow every year without having to sell my investment. Now, some of you are going to like cash flow, some are going to like growth. Both are great. You have to find what's right for you. When you're investing for cash flow, you also have to think about taxes, because as soon as a company pays you a profit, a dividend, or a rental property pays you a profit, which is your rental income, you have to pay taxes on that income. Now, generally, there are ways to pay less taxes on this money, like dividend income generally qualifies for lower tax rates. Your rental income has a lot of potential tax deductions as well. But you have to think about the tax game now as you start generating the cash flow as well. With growth, you have to think about what happens when it comes time for me to sell and it's a recession, because the value of an investment is ultimately worth what somebody else is willing to pay for it. And today that investment might be worth $100. Tomorrow it could be $200, but it could also be $50, depending on what's happening in the economy and shifts that can happen as well. So not one is right or wrong, you have to decide what's right for you. Step number 5 is now an extension of step number 4, which is learn investing, learn what the different options are. So in number 4, now we talked about investing, we talked about it from a high level overview. Do you want to be an active investor, a passive investor, invest for growth, invest for cash flow? Now let's talk about the different actual places where you can invest your money, because the big hurdle that people feel here is, oh my God, where do I invest? Do I invest in stocks? Do I invest in real estate? Do I invest in crypto? Do I invest in gold? Do I invest in ETFs or index funds or mutual funds? Do I invest in individual companies? Should I be invested in syndicate deals or crowdfunded deals? It can be very overwhelming. But the thing that I want you to understand here is the mistake that many investors make isn't picking the wrong investment. It's not investing money. Understand that investing is risky. You're going to make mistakes. You're going to lose money. It's a part of the process, and don't blindly listen to a random guy on YouTube. But try things. Start. That's how you're going to learn. But I'm going to go over a few different investing opportunities that are out there so you understand different ways that you can get started as an investor, even if you've never invested your money before. The most successful place for most people to start investing is a 401k or an IRA. These are government-sponsored tax-deferred retirement accounts, meaning these are accounts where you can invest your money and not pay taxes while your money is growing in these accounts. And then depending on whether you pick a Roth or a traditional 401k or IRA, you're either going to pay taxes on where the money goes in or when the money comes out. With a traditional account, you do not pay taxes when you invest the money. You pay taxes when you pull the money out, when it comes time for you to retire. With a Roth, you're going to pay taxes when the money goes in, and then the money gets to grow tax-free, and then you generally do not have to pay any taxes when the money comes out. Roth has more security because, well, we don't know what tax rates are going to look like in 10, 20, 30, or 40 years, versus a traditional, people are banking on the fact that when it comes time for you to retire, you're going to have less income and thus lower tax rates. So hopefully you will be able to get a better tax advantage there. Which one's right for you? I personally would pick a Roth, but I'm just a random guy on YouTube. Do what's right for you. Personally, I actually don't do a 401k or IRA. They're not right for me. I like non-tax deferred retirement accounts because I have found that you can get better tax breaks outside of these types of accounts. but you got to find what's right for you. Now, aside of the 401k and IRA, there are 3 asset classes that have built more wealth in the United States over the last century than anything else. That are number 1, stocks, number 2, real estate, and number 3, businesses. Now, starting a business is not a passive investment, so I'm not really going to talk about that, but I love entrepreneurship. If you want to start a business, by all means, go and do it. Just understand it's risky. It's going to be a lot of work. Anybody selling you that you can build a business in 2 hours a week, 10 hours a week, whatever, it's hard work, okay? Don't believe that. Number 2, stocks and real estate. These are 2 types of assets that can be passive. Real estate's going to take more work, more money, more time in the beginning, but once you get the hang of it, it is much less time, but it still costs a lot of money to buy properties. Stocks, you can start with as little as $10, $100, even $1, depending on which brokerage you're using. You can buy stocks with the click of a button, but it's much more volatile because, well, as soon as you buy your first stock, you're going to want to know what the stock price is every single minute. That's not the way that you build wealth. You want to be a long-term investor, but just understand that these are the opportunities here. Stocks and real estate have been proven to build a lot of wealth. So when people talk about where do you invest your money, there's a lot of opportunities out there with crypto and gold. And I'm not saying don't invest in those things. Just understand historically what has built wealth sustainably over time. Stocks and real estate make up the bulk, the majority of my investment portfolio outside of my business. And then I have my speculative investments, and then I have my physical gold. My speculative investments include things like cryptocurrency, it includes things like startups, and then I have about 2% of my portfolio in physical gold. Again, I don't recommend what I do to anybody else. Just want you to understand what some of the different investment opportunities out there, and I want you to just start, and then you start learning. Once you decide, okay, I want to invest in stocks, well, now you can start investing in learning. Maybe start investing in research tools. Maybe start investing in other research. Maybe start investing in AI tools that can help you be a better stock market investor. As a fun little point here, I've been talking about how my company, Briefs Media, has been pivoting because of AI. Well, in 2026, we are going to launch one of the most powerful, if not the most powerful, AI tool for stock market investors that I have seen. That's coming in 2026, so something you want to pay attention to. But if you decide you want to invest in stocks, then you've got to start investing in yourself to be a better stock market investor. If you say, I want to invest in real estate, invest in your knowledge as a real estate investor. Read books, buy classes, buy information. That way you can be a better real estate investor, find better deals, and get access to better deals. Step number 6 is pay off your low interest rate debts. So now you've gotten out of the financial danger zone with steps 1 and 2. Then you built a system with your money with a 75-15-10 plan. Now you have 3 different bank accounts, one for your spending money, one for your investment money, one for your savings money. And then you start investing your money and you learn about the different types of investing, and now you're starting to put your money to work. Now let's talk about how do you spend your money smartly, because the reality is if you constantly keep financing your life and keep having these debts, you're working hard to pay back all of your bankers. And you don't want to keep playing this payments game, because imagine this for a second. It's going to seem weird, but imagine for a second you don't have a car payment. You don't have credit card debt. You don't have any student loans. You don't have a home equity line of credit. You don't even have a mortgage anymore. Now the money you make, it's all yours. Now you have more money to spend and do what you want with your money. And it sounds crazy, but it is possible if you build a plan to attack that debt. And this is where, if you have those lower interest rate debts, because you got rid of the higher interest rate debts right here, these lower interest rate debts, your student loans, your home equity lines of credit, your car loans, even your mortgage, now imagine you just can work to pay it off sooner. And if you can do that, you can stop playing the payments game, and now you can keep that money for yourself. And this is where I don't like to finance anything that doesn't put money in my pocket. So if I was you, I'd want to get rid of those lower interest rate debts as fast as possible, because I don't want any financing of something that is not making me money. That includes my car. That includes my student loans, because yes, maybe that's got you a good job, but that student loan is no longer putting any more money in your pocket. That includes my mortgage, because, well, my house is not something that I buy to make money. I buy my house to make memories to live in. I buy my rental properties to make money. And this brings us to step number 7, the spending rules. Rule number 1 is no more financing anything that does not put money in your pocket. The only exception here is your house. So when I buy a car, I want to buy it cash. There are justifications here if you own a business for tax purposes to potentially lease a car, especially depending on what type of car it is. But in general, buy a car with cash. Once you get into the multi-million-dollar net worth, now you can talk about leasing for tax purposes, but that's not what I'm talking about. Number 2, when you go and buy that iPhone, No 0% APR. Even 0% APR is the game that makes the companies rich. It doesn't make you rich. You might say, well, Jaspreet, why would I want to pay $1,200 for my iPhone when I can just pay it off in $50 a month and I can invest the difference? Well, think of it this way. If you walked into your bank today, you walked into Chase Bank, Bank of America, Wells Fargo, and you said, hey, can I borrow $1,200 at 0% interest so I can buy an iPhone? What are they going to say? No. So why are they not willing to lend you that money at 0%, but Apple is going to give you that money at 0%? It's because the 0% APR game is extremely profitable for companies, including Affirm and Klarna and all the buy now, pay later, or as I like to call it, the broke now, poor later games, because they know, number one, you're going to buy more stuff that you wouldn't otherwise, because if you have the pain of $1,200 leaving your bank account, you're probably not going to buy it. Maybe you'd buy a 2-year-old iPhone for $400 instead. Number two, when you don't have the full money leaving your bank account today, it's also easier to sell you the AirPods. It's easier to sell you the case. It's easier to sell you the Apple Care and everything else that goes along with it, because you don't have the full pain of money leaving your bank account. And number three, if you don't make your payments on time, well, now they slap on a 25% interest rate on the back end. 0% APR is extremely profitable for them, not for you. So spending rule number one, no more financing anything that does not put money in your pocket, including your car. The only exemption here is your house. Spending rule number two is when it comes to luxuries, I like to follow a rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. Step number 8 is earn more money. By the time you get here, you're going to have a very strong foundation for your money. You're going to start to see the path to wealth. And now you're going to say, well, Jaspreet, okay, I want to get to this wealth number faster. I'm starting to see the path to my financial freedom. And so you're starting to do maybe something like 75, 15, 10. And you say, well, Jaspreet, what if I just live off of 70% of my income? That way I can invest 20. What if I live off of 65% of my income? That way I can invest 25, which are good, but there's a limit to how many pennies you can squeeze out of your income. There's a limit to how much little you can spend, but there's no limit to how much you can earn. And so now if you can earn more money, now you're going to do it strategically, because the problem that so many people make before is they say, man, if I just had an additional $1,000 a month, all my financial problems will be solved. But you make that additional $1,000 a month, but you get a better car. You get a better apartment, you buy more groceries, you go on a nice vacation. So most people make more money than they spend more money because they don't have the system. But now that you have the system, you can earn more money. That way you can invest more money. And now this earning more money has more power, because now you're earning more money. That way you can build more wealth faster. That's the key. And there's so many ways to earn more money. You can work to get a raise at your job. You can work to get a new job. You can work to get a second job. You can work to get a new certificate. You can go back to school. You can start your own business. You can start a side hustle. You can start learning how to use AI and sell software to businesses. You can learn how to use AI and sell services to businesses to get them up to speed on AI. You can learn how to use AI to build AI tools and sell these AI tools to people who can use that AI better. There are so many ways to do it. I've done many videos on my channel already talking about it specifically with AI. You can check out some of those videos. I'll also link it for you down in the description. But now as you earn more money, the key is to invest more as well. Step number 9 is I want you to start protecting your assets. As a licensed attorney who's at your attorney, what I can tell you is that more wealth comes with more lawsuits. When people realize you have money, they want a piece of that. People like to sue people who have money. People like to come after people who have money. And if people know you have money, well, now you got to learn how to protect that wealth as well. And there's a lot of ways you can do this. Number 1 is with your taxes. Taxes are one of the largest expense for Americans, because there are many different types of taxes that you pay. You have an income tax, you have a payroll tax, you have a sales tax, you have a property tax, you have a capital gains tax, you have a corporate tax. So you want to make sure now that you are not overpaying in taxes. And this is where having a good accountant can help you with that. Then you want to also work with a good attorney. And depending on what you're doing, you're going to want a different attorney. If you're investing in real estate, you need a real estate specialized attorney. If you want to build your estate plan, which now as you start to build wealth, you want to think about how you're going to pass down your assets to the next generation, or do whatever you want with these assets. Get yourself a good estate planning attorney, because the last thing you want to happen is you pass away, whether it's unfortunate because you pass away, but you have no estate plan, and now the government has to decide where your money goes. Or maybe you have a business and you want to make sure you have the right business shields. You want to make sure you have the right IP protection. You want to make sure you have the right contracts there to protect you and your business, and having the right insurances as well. So as you start to build wealth, I need you to start thinking about how you protect your assets, because as you build more wealth, more lawsuits come as well. And then step number 10, give back. The more wealth you have, the more you can do. And there's a lot of ways to give. You can give with your money, you can give with your time, but I'm a firm believer that the more you have, the more you can do, the more you can give. And well, if you can help somebody else, why not? So in this video, we started by laying the foundation of where you stand financially relative to other Americans. And then we said, don't compare yourself to what the median are doing, because the median, unfortunately, are not going to be able to live a life of financial freedom, because we know that statistically, many Americans are not able to retire comfortably. The next thing we did is we came up with your goal. How much money would you need to actually be able to live your life financially free? And so you came up with a number, then you followed the 4% and the 7% game plan to see how much money you actually need to get there. Then we laid out the 10 steps to get that wealth faster, because now we have an actual game plan of how do you build that wealth. We talked about number 1, saving you $2,000, and number 2, getting rid of the credit card debt. This is the financial danger zone. You got to do steps 1 and 2 as fast as possible. This requires the most sacrifice during these 2 stages. Then number 3, we laid a financial system of 75, 15, 10. 75 cents is the maximum of every dollar that you earn that you can spend. 15 cents is the minimum that you're going to be investing, and 10 cents of every dollar that you earn is the minimum that you're saving. That way you're always saving and investing your money before you spend your money. Then I talked about the investing masterclass, where if you're interested in becoming an investor, or you are already an investor and you want to see how you can find better investment opportunities, I have a free investing masterclass for you down in the description. Then we talked about how do you actually invest your money. We talked about being an active investor versus a passive investor. We talked about growth investing versus cash investing. So you can start to think about different ways to invest your money. And then we talked about how do you actually make it happen by learning how to invest. You can invest in stocks. You can invest in real estate. There are more speculative investments that you can make as well. And as you start to make those investments, start to learn how to invest as well. Invest in your own investing knowledge, because that can compound your returns as well. Then we talked about paying off your lower interest rate debts, that way you can stop paying the payment scheme. Then we laid out some spending rules, which include no more financing anything that does not put money in your pocket, and my rule of 5 for luxuries, which is if you can't buy 5 of them, you can't afford 1 of them. Number 8, talked about earning more money strategically now, that way you can earn more money, that way you have more money to invest. Number 9, we talked about as you have more wealth, you also will see more lawsuits, so start to protect them sooner. And then number 10, we talked about the importance of giving back. If you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this financial education. Thank you. It is getting harder than ever for the average person to get a job and build wealth, because traditional entry-level skills are now being automated by AI. But this is the silver lining, because for those of you that are go-getters that want to go the extra mile, this shift is going to create more millionaires than ever before. And yes, the things that I'm about to show you will apply whether you work a job or run a business.